Debit, credit. Ever hear those two words and just feel your brain start to shut down? Well, what if I told you there's a super simple, logical system to make it all finally click? Today, we are going to pull back the curtain and demystify all of it using just 3 golden rules of accounting. Let's dive in. Look, if debit and credit have always felt like you're trying to learn a completely foreign language, you are not alone. It is probably the biggest hurdle for anyone trying to understand business finance. But what if I told you there's a key to translate it all, and it's way simpler than you think? It all boils down to this really elegant system that's built on just 3 golden rules. If you stick with me, I promise by the end of this, you'll see exactly how these rules turn that tangled mess of confusion into something that is crystal clear. All right, first things first, before we even touch the rules, we need to understand the 3 simple buckets or account types that every single business transaction gets sorted into. Once you get this, you've got the foundation for absolutely everything else. So our first bucket is the personal account. And just like it sounds, this covers any dealings with people, companies, or other organizations. The easiest way to think about it is this. It tracks who owes you money or who you owe money to. It's all about the who. So, we're talking about the account for a specific customer, a supplier you buy from, or, even your bank account, because the bank is its own entity. If it's a person or an organization on the other end of the transaction, it's a personal account. Simple as that. Next up, we've got our second bucket, real accounts. Now, this is where we keep track of all the actual stuff the business owns, its assets and its properties. And that includes things you can physically touch, like a building, and things you can't, like a trademark. Think of the cash in the register, the office building, the desks and chairs, or all the products sitting in the warehouse. If the business owns it, it's a real account. This bucket is all about the what. And our last bucket is for nominal accounts. I like to call these the story accounts. They're temporary and they track the why behind your money moving around. All of your income, expenses, gains, and losses over a certain period of time. This is where you'll find things like your rent expense, the salaries you pay out, sales commissions you might earn, or the interest you're paying on a loan. These accounts are what really tell the story of how your company is performing day to day. Okay, quick recap. We have our 3 buckets: personal, which is the who, real, the what, and nominal, the why. Now that we know where to sort everything, we can finally learn the rules that run the whole show. Think of this as the grammar for the language of business. Now, you might want to take a screenshot of this because this is everything. This is the entire system right here. For personal accounts, debit the receiver, credit the giver. For real accounts, debit what comes in, credit what goes out. And for nominal accounts, debit all expenses and losses, credit all incomes and gains. I know it seems like a lot at first, but trust me, there is a perfect logic to it. All right, knowing the rules is one thing, but seeing them in action, that's where the light bulb really goes off. So let's stop talking theory and actually put these rules to the test with a couple of real-world examples. We can break down any transaction with this simple 4-step process every single time. First, you identify the 2 accounts involved. Second, you classify them as personal, real, or nominal. Third, you apply the right golden rule for each one. And finally, you determine which gets the debit and which gets the credit. Let's try it. Okay, let's start with a super common one. A business pays its monthly rent using cash. Let's run this through our 4-step machine. Okay, steps 1 and 2, identify and classify. So what are the 2 accounts here? Pretty obvious, right? Rent and cash. Now, let's classify them. Rent is an expense, so we know that's a nominal account. And cash is an asset, something the business owns, so that's a real account. Easy enough, right? Steps 1 and 2, done. Now for steps 3 and 4, where the magic happens, we look at our rent account. It's nominal. The rule is debit all expenses, so the rent account is debited. Then we look at our cash account. It's real. The rule for that is credit what goes out. Since cash is literally going out of the business, the cash account is credited. See that? A perfect logical balance. Let's do one more just to make sure this is locked in. This time, our business buys some goods from a supplier, but does it on credit. Now, this is important. No cash is changing hands right now. So, our 2 accounts are purchases and the supplier. Purchases are an expense, which makes that a nominal account. The rule is debit all expenses, so we debit the purchase account. The supplier is an outside person or entity, so that's a personal account. And what's the rule? Credit the giver. Since the supplier gave us the goods, we credit their account. The logic just works every single time. Okay, This is cool. We can now analyze transactions one by one. But why does this tiny little detail matter in the grand scheme of things? Well, this is where we connect these simple rules to the big picture, understanding the health of an entire business. Here is the crucial takeaway. Every debit and credit you record isn't just some random entry. It is a single building block. These entries are what literally build your most important financial reports, like the income statement and the balance sheet. They are the raw data used to calculate profit and loss. This simple system is the absolute foundation of all reliable financial reporting. Now, as you start using this, just watch out for a couple of common traps. The number one biggest mistake is thinking debit always means increase and credit always means decrease. As we just saw, it totally depends on the type of account. The other big one is just misclassifying an account right at the start. If you put it in the wrong bucket, the whole rest of the process is going to be off. You know, the source material we're using for this explainer says it perfectly. Mastery of these rules eliminates guesswork and builds strong accounting fundamentals. And that's really the whole point. You're no longer guessing, you're applying a logical, consistent system. So, you now have the key. You have the grammar to finally understand the language of business. Every financial report, every balance sheet, it tells a story. A story of success, of challenges, of strategy. So the only question left is, what financial story will you be able to read now?